Welcome to this video on putting together a trend following system. And today we're going to talk about the basics of a trend following system, which generally is considered, and by the way, I will also add incorrectly considered, to be based on higher highs, higher lows, higher highs, higher lows, higher highs. Now, we've all heard that, and that's supposed to be a trend. That is not enough. So it's not that that's completely wrong, but there are some things in trading that are complete truths, the whole truth and nothing but the truth. Other things that you read about in trading are half-truths, and this is a half-truth. So let's get to the whole truth and nothing but the truth and show you why that is not enough. And in fact, I was on a webinar the other day and I liked what a woman said. I've adjusted what she said a little bit. I used to say, okay, so this is your basic meta pattern, and that's true, but we've got to add more details to it in order to make it more specific and accurate and precise. And so I said, the devil's in the details. And she said, no, heaven's in the details. And I kind of like that. Actually, I thought, oh, that's pretty good. So I decided to change that up a little bit and to say the dinero is in the details, or the dollar's in the details, if you will. So let's take this higher high and lower high stuff off of here, because it's not meaningless, but it's not enough. So, okay, let's move our charts forward. It's not letting me do that. There we go. All right. So technically, if you look here, we do have a higher high. From this high to that high, definitely a higher high. So is that a trend? Should we build a trend following system around that? And the answer is absolutely positively not. That is not enough detail to create. Now it's a higher high, that's correct, but it's not a trend continuation. And here's why. So in the markets, you have to give the markets some wiggle room. You got to allow for some noise in the market. You've got to allow for some chaos in the market. You got to remember, there's people all over the globe who are trading these markets, and they're trading from different countries using different methodologies, different time frames, different systems, algos. Some are discretionary traders. So anyway, you get millions of people all trading this stuff, and nothing's going to come out exactly to the penny, to the pip, to the tick, or to the pixel on your chart. So bottom line is you have to allow for that variance that is just part of the system. So what I do, instead of just saying, okay, we need a higher high, I go like this. I take a horizontal line, and I'll put it at that high. Let's see, it looks like it's about right there. And then I say, okay, so yes, we did make a higher high here. That is correct. But what actually is going on there price-wise? What is the dynamic of the auction place? Because that's really what markets are. Markets are huge auction places. So what's actually happening here, and if you've ever been on the floor of the exchange like I have, well, at the CME anyway, I did a couple stints out there at the Chicago Mercantile Exchange, got to be down on the floor with traders, all that kind of stuff, and you really see and feel, it's a visceral thing, the energy of the money flow, and it's a big advantage. And then when I came back to screen trading, I brought that experience with me, and I'm like, oh, now I understand. The charts are just mapping the math of the mass psychology that's going on through the exchanges. So that's all that is. The real market is what's going on between people and these days, computerized systems and so forth. So when we look at this, and again, allowing for a little bit of chaos, randomness, and so forth in the market, what we see here is, sure, you get a higher high, but that's just the very high of where we reach. What really was the auction place saying? In other words, the masses. What's the mass psychology there? We got a little bit above it, made a little bit of a higher high, and then eventually, and right away, the market reverses, right? So it negates the bar before that. In my type of my type of candlestick analysis is a little bit different than most. So I don't really stick to the traditional Japanese candlestick pattern trading. I think it's a little outmoded. That's my personal opinion. But anyway, so we say that in TopDogTrading, the red bar negates the green bar. All right, then we get a neutral bar, and then we make another attempt. So the market, I should say, makes another attempt, says, yeah, let's try it again. And then again, now what happens? This bar is splitting this high, these highs. So it opens below, it closes above, reaches the high there, closes above. So the overall dynamic of the auction place is that starts down here, ends up here. Okay, we're testing these areas. That's what's happening. The market is constantly testing previous support and resistance levels because the market has memory, as they say. And so the participants are actually thinking, okay, that's the value of the market that was established in, well, in this case, about an hour ago. And so people, when they come back into that level, get a little nervous. The uncertainty, which the market hates, comes in, and people are thinking, well, I don't know. This is the highest value that people are willing to pay. Again, think of it as an auction place. Think of it like selling your car, right? You might want to sell that car for $20,000, and that's great. But if no one's willing to pay you $20,000, you're not going to sell it for $20,000 because there's no one on the other side of that transaction to pay you that much money. Now, they might pay you $18,000, and then you have to decide whether or not you're willing to take less or negotiate something in between. That's the exact same type of dynamic that's happening here. So the answer here is no. No one's willing to pay $121. Now, I shouldn't say nobody. Oh, you can't see the price there anyway. That's at $121. So we get a few, but we can't get enough buying traction. There's not enough buyers to make this market sustain to the upside. So actually, let me forward here to the right a little bit more so you can see what actually happens. So the way that we read this again is, all right, so this green bar here, that's just an attempt. This is the market participants testing, all right, do the global markets, the global market participants, is their sentiment now bullish enough to break through that resistance level and say, yeah, we're willing to pay more than that now. And the very next bar, the red bar, answers the question and says, nope. And in market profile terms, this is called a rejection of value. So I'm not the only one who talks about this stuff. This is now saying the market has, and the term again is rejection of value. It's tested these higher prices, and the global markets have rejected that, meaning not enough people are saying, yeah, I'm willing to buy that. I believe the market is worth that. They're saying, no, the market's not worth that much. That's overpriced. I'm not buying. And if you don't get enough buyers coming in there, you don't get enough buying traction, it will not follow through. And so therefore, that is not, so for example, we call this a wave one, and we call this a failed three because it attempted to go higher, and it did go higher, but it actually could not, again, get enough traction, and so it actually becomes a bearish pattern. It's actually the opposite of trend following to the upside, and it becomes a reversal pattern. And so that is the kind of thing we would actually take short. If you like this video and you got some value from it, of course, it's absolutely free on the internet. Hey, everything on the internet is free. But you know what? I think we get so used to everything being free that we forget about our moral obligation. That if you find something that's really good that you like, and I do qualify that, if you got value out of this, then I really encourage you, the best thing you can do is to click the share button. That is number one. Click the share button below. That provides value to other people. That's your way of paying it forward. I don't charge you anything for these lessons. I've got over 100 videos on YouTube right now. They're all free, and I don't ask you to pay me any money. The only thing I ask you to do is pay it forward and share it with other traders. So click that share button and share the value with other people. And by the way, click the thumbs up icon. That helps a lot. Your comments I love. And I'm also giving away one of my favorite trade strategies called the rubber band trade, which has a very, very high win-loss ratio. So this is a value added. It's also free, by the way, but it takes a little longer than my YouTube videos. So it's 26 short minutes, but these YouTube videos I try to keep to around 10 or 12 minutes. So I'll be happy to give you my rubber band trade strategy absolutely free. Just click on the image on the top right hand corner of this video, or the link's also in the description below the video. And if you're not watching it on YouTube, there's probably a link below or an opt-in form on the side. Anyway, once you do one of those options, I will be happy to personally email the video to you with the rubber band trade strategy.